Hello, everyone. Welcome to today's webinar with me, Fawad Razakzada, and my colleague Victor. We will be providing a preview of the upcoming jobs report. So this webinar will be divided into two parts. First, we will discuss some pre-NFP leading indicators that we've had over the last week or so. To try and come up with a rough idea of how the headline jobs number may look like and how this in turn might impact the markets. The second part will be all about technical analysis of a few major currency pairs, indices, gold, in order to provide some actionable trade ideas after the jobs reports published. So we will be discussing those two main parts of this report. Obviously, don't forget to ask us questions, guys. This is a live webinar, obviously. We love to hear from you guys. And I can see that there are quite a few of you in this room today. So please try to ask us as many questions as you can. But please try to keep it relevant to the jobs report. If you're interested in our analysis in terms of other markets that are not necessarily directly related to NFP. Please reserve those for our live webinars that happen every Tuesday. Anyway, without further ado, let's begin. So these webinars are for general information only. They are not intended to provide trading advice or investment advice or any personal recommendations. So any information relating to past performance of an investment does not necessarily guarantee future performance. Think markets shall not be responsible for any losses you incur, either directly or indirectly arising from any investment based on any information in this webinar. Please remember that the spread betting and trading CFDs carry significant risks and may not be suitable for all investors. I talked about the agenda for today's webinar, so no need to repeat that. Why is the jobs report so important, Victor? I'm going to put you on the spot there.
Sure. So the jobs report is the most accurate representation of the current state of the labor market. It's an important mix in the decision-making process of the Federal Reserve regarding its monetary policy. So that's pretty much why you should care about it. Although, like, I'm gonna argue a little bit here that the current environment that we're in. The Federal Reserve is pretty much on autopilot towards tapering.
Yeah.
They have signaled it kind of, so clearly that there is no, like, I don't think there is any data that can come out between now and November that will deter them from taking the path of starting tapering and reducing asset purchases, which obviously is something that the market is very much looking forward to.
Indeed.
So yeah, my take here at this point in time is that while the number matters, it doesn't matter that much because well, if it's pretty bad, then you're probably gonna get a better opportunity to buy dollars.
Right.
If it's pretty good, well, you should have bought dollars earlier.
Indeed.
But I'm just gonna say it right here and now. Being a dollar bull for over the past couple of well, several months already.
Yeah, you have been.
I'm gonna just single out that until tapering actually happens, the dollar is very likely to be rising. So if we have a pause in non-farm payrolls, that doesn't mean that you should suddenly start shorting dollars.
Right.
That's my
The,
view, of course, and it's not an investment advice.
obviously, yeah. Let's make that clear as we did it at the start of the webinar. Obviously, the dollar has had mixed
Yeah,
performance. It's done really well against currencies where the central bank is more relaxed about inflation or high levels of inflation. For example, the Bank of Japan, Swiss National Bank.
yeah,
In those nations, we haven't seen inflation for many years, and so inflation overshooting now is a welcome sign for them, and that's why their currencies have weakened relative to the dollar. So we've seen the dollar yen break out, we've seen the dollar Swiss rise, and we'll cover those currency pairs in a minute or so. But just to add to Victor's point that the Fed's next meeting is taking place on November 3, which will be exactly 2 days before the next jobs report is published. So therefore, today's jobs report is the last one for the Fed officials to consider before publishing their tapering plans. So it will be scrutinized very closely by market participants, we think, and we may see some big moves in the markets in response, especially if the numbers deviate significantly from expectations. Although, as Victor mentioned, unless it's really bad, the most likely scenario will be that we may see a continuation of the trends that we've seen in the market, with the dollar doing relatively better against some of the weaker currencies, whereas stocks, well, stock markets will be interesting to watch closely. I'll tell you why. It's because of bond yields, but we'll cover that in a minute or so. Let's just quickly look at the expectations insofar as this month is concerned. We have headline number expected at 490,000. So I think anything around that number, it's not going to cause too much of a problem insofar as the Fed is concerned. They will go ahead with their tapering, unless we see something like 100,000 increase or maybe a negative number. That will come as a shock and may cause the Fed to pause possibly until January. Yeah.
How are the leading indicators into this?
The leading indicators have been decent. Before we discuss leading indicators, let's just remind our attendees in this room that the unemployment rate has seen falling to 5.1%, and that measure of inflation, which is average hourly earnings, this is again expected to show a big number of 0.4% month-over-month increase after a big 0.6% rise the month before. Now, the NFP indicators that we've had in the last week or so have been quite decent, I would say. The ADP private payrolls report, which comes out on a Wednesday, this came in better than expected at 568 versus 425 expected. The employment components of manufacturing PMI came out better than expected at 50.2, although the services PMI employment component was slightly weaker compared to the previous month, but it was still above the 50 level, which is the boom bust threshold. So it rose. It points to expansion in employment in the sector, but at a slower pace than the previous month. Although in manufacturing sector, it expanded at a faster pace. And the 4-week average of jobless claims fell further to 344,000, again showing that people are applying for unemployment-related benefits less than they were in the previous 4-week average period. So all good news, I think, overall. And as a result, we should see, I think, a stronger jobs report or around expectations. So if it does come out in line or slightly above, these are some of the ideas I have put together. I don't know if Victor will agree with all of these, but I reckon that if NFP is in line or slightly above, we will this will more or less cement those tapering expectations, in other words. And even if the data disappoints slightly, I can't imagine the Fed walking back on its tapering plans on QE taper. But if it's really weak, like 100K or even lower, then we may see the Fed wait a little bit longer. So anything around expectations, I would say would be positive for the dollar, especially against currencies like the Japanese yen and the Swiss franc, which I mentioned earlier. That those central banks, they are happy to see a bit of inflation coming into their economies after many years of disinflation or deflation. So the Bank of Japan and the Swiss National Bank are not going to be adjusting their monetary policy stances anytime soon, whereas the Fed, the Bank of England, and a few other central banks are starting to talk more hawkishly about the part of their interest rates, which should fundamentally support their currencies against those less or those lower yielding currencies, let's say. Gold might struggle as well because when bond yields rise, that rises or that increases the or reduces the appeal of gold, because gold doesn't pay any interest and costs money to store. So investors may choose the relative safety of bonds to enjoy a fixed return, a fixed and a stable return, rather than making no returns on gold. So that's why I think the gold market might struggle if we see the data come in stronger. If it comes in really bad. Sorry, Victor, were you saying something there?
Yeah, no, go ahead.
I was just going to talk about the other trade idea. If the jobs number comes out really bad, in that case, we may see the dollar weaken. And if that's the case, then currencies like pound, possibly the euro, maybe the Canadian dollar, which has been benefiting from a stronger crude oil prices, these currencies might perform better than the US dollar. And gold might also find support because of potential weakness in the dollar. So those are the scenarios that I'm looking at ahead of the jobs report. Anything to add to that, Victor?
Okay. Yeah, so I don't see a third scenario. You say NFP in line or slightly above expectations. Obviously, we do have the version where it blows out expectations.
Oh yes, yeah.
And I'm gonna just chime in with something that I mentioned last time and we didn't see
which
materializing, but this is the first month when all the financial aid has been stopped for for people without jobs, and so basically the government aid has lapsed, and this is the first month where you will see the real the real demand for work, because up until this time around, the government has been impacting demand for work because it was paying unemployed people extra.
Yeah.
So this is the first month when we're going to see finally the real snapshot, a more realistic snapshot of the labor market and demand for work.
Okay, interesting point there. There's a question from HH Hassan. How do you actually trade these the numbers? Do you fill market orders before the event or wait for the event to take place and then decide what to do? In large part, me personally, the way I would trade is I wait for the report to come out, then place trades. Sometimes there are occasions where I hold a position heading into the jobs report, and depending on my expectations, I either tighten my stop loss or reduce the position size with the aim of re-entering again after the jobs report is published, or maybe hedging it. So it really depends. But largely what I do is I have these ideas that I'm going to play out, and I sometimes place limit orders below or above market for those things to trigger, for as long as those limits are well above or well below the market, just so that we don't see a surprise in the jobs report. that could trigger a massive move in the other direction that I was expecting. So I do use a combination of these order types to get in on potential trades. But normally, majority of the time, I would say I wait for the market to make its move. Then, if the jobs report, for example, if I was expecting a bullish, a strong jobs report to come out, and I expect the dollar to go up, normally what happens is the report comes out and the dollar responds in that way. Then it comes back down, and then I would look to start buying the dip with the market or limit order. So yeah, there is a risk that you could miss the initial move, but more often than not, the market always gives you several other opportunities to get on board. By the way, you don't have to buy it right at the bottom, right? For as long as you are you have a high risk to reward profile, you know where you end up. The most important thing is to know where your invalidation level will be, where you're going to place your stop loss. From that, you can work out your position size. Yeah.
How much can you afford to lose on a certain position? And this is valid for any trade, not only for NFP.
Exactly.
But yeah, so why don't I chip in here? So
sure.
I think that the best way to trade any news event is with entry orders. And I tend to place those before the event at certain levels that are far enough from the market price. And that's the way I prefer to trade it. Obviously, far enough, but not too far. Being likely to if the number is too bad, then I think that certain spike can give me a good entry level opportunity, that I just place an entry order there and wait for the market to go there. If it doesn't, it's okay.
So sometimes you could use things like ATR bands, which are the like average true range bands, or measures of volatility, like 1 or 2 standard deviations from the current market price, with the stop being like 3 standard deviations below, for example. So there are so many different ways people trade these news events. There's no right or wrong answer. It just depends entirely on the type of trader you are and your strategy. I would always say that the best thing to do is not to trade ahead of the jobs report. It's always best to wait. But
in terms of that, I feel the same. Like you never know what the number will be. So in order to avoid nasty surprises, the safest thing to do would be to just sit it out a little bit.
Indeed. So as we now transition to technical analysis, we know what we want to see from the jobs report, or we don't want to see from the jobs report. You can set out scenarios to trade the market in that direction. And so we are going to cover a few currency pairs to start with, but I always look at the dollar index because it gives you a snapshot of what the dollar has been doing, mainly against the euro, because obviously the euro is a bigger representative of the dollar index. And as you can see, the market is making higher highs and higher lows. It all makes sense, as Victor mentioned, because the Fed is more hawkish than the ECB and many other central banks. So people are investing in the US, hoping for a better return on their investments, which is why the dollar is rising. It has broken above this resistance zone that I've just shaded in gray. For as long as it holds above here, I think the path of least resistance would be to the upside. And from here, it looks very likely, in my view, that we will tag and probably go on to rise further above the high that was hit last year in September at 94.74 right here. So that's the next key level to aim for as far as the bulls are concerned. Notice that level was previously a support right here. So it could be that we may form a double top or something, or at least a short-term double top. So is the area around this low here at 94.65 to September's high at 94.74, which I will be looking at as the next potential resistance, right? So it's not an exact level. It's a range. Beyond that, then there's no further reference points to look at until 95.71, which is this low right here. This being the last support zone before that big breakdown happened. So that level remains exposed for a potential retest. So those are the two upside targets in the immediate term that I would be looking for on the dollar index. On the upside, and on downside, the shaded region that I've drawn on the chart. Those will be the levels on the daily time frame. Obviously, there will be several other levels. There will be several other levels on the intraday charts. Which currency pair would you like to, Victor, concentrate on? Should we look at dollar yen?
Oh, sure. Why not? Why not?
Why not? Yeah.
It's we've actually highlighted something about the dollar yen a couple of weeks ago during our regular webinars, which are every Tuesday at 11:30 a.m. London time. We highlighted that the tight range between 111 and between 109 and 110.50 would lead to some sort of a conclusion sooner or later, and that conclusion, I feel, has been reached. The market concluded that a break to the upside is the most sensible sensible move at this point in time, and ever since it has managed to crawl up about 150 pips above previous highs around 110.50. So yeah, at this point in time, I feel like we could have a trend move in the yen. The only thing stopping that is probably a risk of, a risk of scenario where stocks suddenly start to sell off, and
that is a big risk, and we will look at the indices in a minute or so, because obviously when the bond yields tend to rise, they reduce the appeal of growth stocks, especially in the technology sector. So the NASDAQ has the potential to weaken, and that could trigger a risk-off response in the markets, which in turn could lead to some safe haven flows into the Japanese yen and the Swiss franc. But if it's only mildly risk-off, I don't think that is going to matter too much in so far as this bullish trend is concerned. So as Victor was speaking there, you mentioned the breakout above the zone. We've held that zone now on the retest. It looks very likely that we may go on from here to tag the high from last year, the pre-pandemic high, at 112.22 next. So that will be my first objective. I've also drawn a few Fibonacci retracement here, leaving just the extension levels on the chart because the retracements are no longer valid. So the 127 extension comes just above last year's high, which makes this area between 112.22 to 112.50 or 45 a potential resistance area to watch out for. This will be my kind of target on the upside for the dollar yen. You need to take it from one level to the next because, as Victor mentioned, there's always that risk that equity markets might sell off, and that in turn could weaken the dollar yen as haven flows support the Japanese yen. Let's look at another similar currency pair, the dollar Swiss, because something interesting is happening in this market, at least from a technical
A
point of
long
view anyway.
term, a
Yeah,
long-term trend line.
yeah.
Yeah.
So the more a trend line gets tested, the more likely it will break in the direction of the test. Yeah, so this bearish trend line has been tested several times, but we're building, on the longer time frame charts, higher lows, as you can see. A very tight range is being built just underneath the trend line now. So unless risk turns really sour, I can't imagine this trend line not to break in light of rising bond yields in the US, where, as I showed you earlier, they have broken the 156 level. 160 was tested today. There's no reason, in my view, that why bond yields can't go and reach the highs that were hit in March of this year, because since then, inflationary pressures have increased significantly further. The economy is in a much better state. The Fed is a lot more prepared to taper QE. So as far as I'm concerned, there's no reason why we can't see 175 or even higher in yields in the days ahead. So that should keep the dollar fundamentally supported against weaker currencies. So yeah, that was what I was looking at for the dollar Swiss.
So we're looking for a break above 93.50, I guess,
93 thereabouts. Yeah, 93.25 to 50 area. So there are a couple of nice hammer looking. Well, there was one hammer yesterday formed following a doji candle the day before. So it looks like on the daily, the dollar Swiss is forming a base here. And so if you wait for the jobs report to come, see how it reacts initially, and then maybe look to go along on the dips if you still feel that the dollar Swiss wants to push higher. So that could be an idea to monitor levels such as 93, which is interim resistance, but it could turn into support if we break above it.
So there are a couple of questions.
Okay.
And before we move on to another currency pair, I wanted to suggest that we have a look at gold.
Okay.
We do have Emmanuel asking if the dollar is strong, will gold go short massively?
Right.
Probably yes, is the answer in my view. And HH Hassan is asking if I can give an example of the trading style I use on gold. So if we can just have a look at the shorter term chart, so I identify like what, if you switch over to the hourly, because I think that he's asking about the entry order levels that I would, for example, use in this case. Well, I would be short gold at 1770. Like I would put an entry order there.
1770.
This is pretty much the key area that has been the previous, the previous high. So a sell order at 70.70 would be my preference in the case of gold.
Just to mention, obviously what Victor's talking about is his personal opinion. It's not trading advice, guys. So
yeah, it's not trading advice. Yeah, and that would be since I'm biased to short gold, obviously to go long the dollar.
Yeah,
that would be my entry level. So this is how you basically have a view on the market. You select the key level. You think that, okay, maybe at this level there's going to be enough buyers, and you go ahead and place an entry order at those levels. I feel like this is how most bigger players in the market trade. Like
Yeah.
they have orders at certain levels that they find significant. So
Yeah.
what the small guy wants to do is to replicate what the big guys do.
Indeed. Can I just add? I know you asked Victor the question, but the way I would look for entries, not just in gold, but in anything, I'll give you obviously this a example of the past things that have happened already. So say I imagine I'm looking at this market and the market is doing something like this, right? It's just broken up and now it's starting to break lower. So once it breaks down, I would naturally look at this area of prior support that led to that move up that's ultimately failed and that we've now broken below it. So the reason sometimes why it's important to wait is because you will get market action like this. So you might not have entered at the top because then you didn't have any confirmation. You might not have entered immediately right there because the market broke down because of some economic news like the jobs report or whatnot. But what you can do is wait for the market to come back down, come back up to retest the breakout area. Notice we've also taken out a bullish trend line here, etc., etc., etc. So this gray zone is where I would be inclined to enter short the next time the market comes up to it. Whether or not it will hit that level remains to be seen. We may have tagged it right here because I didn't draw this properly. Let me just zoom in because my mouse is not really very sensitive. There you go. Yeah, we tagged it right here. So you could have placed a short order right there, like a limit order. But even if you missed this one, then what you could do is, you could you could wait for the market to take out these lows. Yeah, and then what you could do is you could say to yourself, if the market breaks this down, I'll sell the retest of this level, placing your stop above the range high in order to take you lower. This is a hindsight example, but it's nevertheless how I would trade. There you go. So in this case, when it breaks down, you want to see a decisive break. This is a fake out. Yeah, you want to see the candles close and stay below for a while before looking to short the retest. So in this case, if you sold it short immediately after the break, more often than not, this is what happens to retail traders. Market goes up, but nonetheless, it has now come up to the key resistance area where you are more likely to get a really nice entry. And lo and behold, the market breaks down. And now look, this is the sort of clean breakdown that I'm talking about. Nice clean break. Whether or not the market will now come back up to this area remains to be seen. But if it were to come back to around here somewhere, so I can move this lower, this is where I would now look to enter short at some point in the future. So keep an eye on that area as the market does its thing. I'm not sure if it ever came back to that level before going down. Oops, there you go. It did. So right here, testing the prior lows, I would enter short right there, placing a stop probably somewhere here because that was the most recent high prior to the breakdown. So this is how I normally trade, just to give you some ideas. And just watching the market, let's see what happens. And there you go. The market has broken this low. So my first target would have been hit because I placed my limit orders where trap traders, stop loss orders might be resting. And so that would have been my first target in this case. I personally didn't trade gold short. I'm just giving an example of how I would have gone about it because we talked about it. So there you go, just to give you some ideas. let's move on and look at. Actually, we didn't talk about gold in terms of where it's likely to head to. I feel that gold is still in danger of falling further because of rising bond yields, and the fact that we haven't been able to climb above last week's high and hold there is potentially an early sign of trouble for the bulls. Last week
Yeah,
we formed this hammer candle, and so far the market is struggling or refusing to hold above last week's hammer high. So it's an indication that the market is positioned short, that it wants to move lower. However, if we do go back above last week's high after the jobs report and we see the hourly candles close above, then maybe that would be a positive sign. So that level on the daily is this right here at 1765. In any case, I have marked out this level as being the invalidation level for the bears, because that was the most recent high prior to the breakdown. So for as long as we remain below this black level here at 1787, I think the path of least resistance would remain to the downside, regardless of what price does in the short-term outlook. Okay, let's move on and look at indices. And in particular, I want to talk about the NASDAQ, because the NASDAQ, obviously over the last few days, we've seen the market form a low and recover nicely. However, it has now arrived at key resistance, namely at 15,000.
yeah,
Which is the backside of the long-term broken trend line on the weekly time frame. So the NASDAQ broke this trend line. The NASDAQ broke this trend line last week. We closed below it. Now it's being retested from underneath. And with bond
yeah.
yields on the rise, could we now see the NASDAQ go lower from here? I am inclined to
I would say
say,
absolutely.
yeah. I think it's very risky for the bulls right here. The bulls need to reclaim 15,000 on a daily closing basis now.
Yeah,
So
and it's been strange. Like in
yeah,
recent days, while yields have been rising,
exactly.
the Nasdaq has been rising as well. So eventually, we might see a reversal to the mean, which means that
200 day.
the Nasdaq could test its lows once more.
Indeed. So there are a couple of interim support levels to watch. Guys, just give me 1 second. There's something.
So yeah, while you're at
Mhm.
it, I'm just gonna mention this morning the Bank of England has
Okay.
communicated that asset prices could like the levels of asset prices could falter significantly.
Oh, right. So that should have supported
It's
the pound. I missed
it's
that.
it's a warning for it's a warning for all those people that think that trading the stock market means buying every dip.
Yeah, it's not really that the case. It had been a very good way of engaging in the markets previously, but now that central banks left, right, and center are telling us that monetary policy is going to be tightened in the coming months and quarters, you need to proceed with extra care now. Okay, especially because we've seen some technical weakness signs already come in play in some of the major indices. And also look at China. Obviously, China has had a really good few days in recent times, but the sell-off in China started back in February, months before the rest of the world started to break down. So if China is anything to go by, because China was the first to come out of lockdowns, and etc., they reduced stimulus. The US could be, they are the largest economy in the world. we could see similar price action in the US indices in the months ahead. So given the trend break that we saw on the weekly time frame of the NASDAQ, the importance of the 15,000 resistance level, there was increased risk that we may see the return of the selling of the sellers here, especially if support at 14,800 breaks down. This is interim support level that was previously resistant. So the bears need to reclaim this 14,800 level. And then if they manage to push the index below this, then the next target will be 14,450, the recent lows. And then thereafter, there's nothing significant until the 200-day moving average, which also happens to come in around prior support and resistance area. So there is a possibility we may see a significant drop in the NASDAQ if 1480 is reclaimed by the sellers. There are a couple of other comments, Victor. If the dollar's okay, you answered that one. Comment: trading requires nerves of steel to be successful. It does require some level of steel,
A lot.
nerves of steel. It depends on your account size. The bigger the account size,
exactly. That's a very good point here. Like, if one is using too much leverage, it's very easy to lose your nerve.
Yeah.
So just be careful with your position sizes and don't overcommit to like, don't open positions that are too big to your risk tolerance. So basically, don't, like, we're all trading on margin, but that doesn't mean that we should use it all for one position.
So let me add to that point. In general, in life, right? You only get nervous because you're not prepared for something. Imagine speaking in front of like 100,000 people, and you're not prepared. You haven't prepared. You don't know what you're going to talk about. You're obviously going to be very nervous. You'll get stage fright or whatnot. And taking part in some sporting activity, if you haven't done the required training, you're going to feel nervous. You're not gonna, you don't know how you're going to look in front of people because all your other colleagues might perform better than you, etc. Same with trading. If you're over leveraging, if you're not prepared, if you don't know what you're going to do before entering a trade, anything you do that you're not prepared, that you haven't prepared prior to doing in trading, will make you nervous. Otherwise, there's no reason why you should be nervous, right? You're nervous because you're not prepared, or you're nervous because you've risked too much. Both of those things are under your own control. Yeah, obviously the market's direction is not under your control, but you can control what you can control, and those are your position size, your decision to enter, and the level of your preparedness before entering a trade. So if you
so
if you address those issues, and if you find yourself getting nervous each time you enter a trade, you're doing something wrong. It's either because you're risking too much money that you can't afford to lose, or you're not prepared, or a combination of the two.
Yeah, there is an unwritten rule to risk on one position.
Yeah.
Not more than 2% of your capital.
Yeah.
So imagine you have a $2,000 account, and 2% would be $40, right?
Right.
So the size of your position should be adjusted to reflect
your account size.
Your account size.
Yeah.
So yeah.
And your level of risk tolerance. For some person, 2% might be too much. For others, it might be like nothing. So again, it's not. It's just a rule of thumb. It's not rocket science. It's or it's not exact science, I should say. It should be a percentage, or even nominal amounts that you will not lose sleep over if the trade didn't go in your favor. Anyway, does it mean the NFP is going to show positive data based on the other? Not necessarily. Anonymous attendee. The name of the attendee is not there, so he asked or she asked a question: if NFP leading indicators show positive, is the jobs report necessarily going to beat? No, they're just that, indicators. Indicators indicate what the outcome might look like, but it's not an exact science. So we've seen actually, on this point, ADP has historically been a very poor leading indicator for the official jobs report. So you have to take all these indicators with a pinch of salt. Are there new regulation regarding giving advice for brokers? Not that we are aware of, but the brokers like us, we are not allowed to give advice. We are execution-only brokers. Anything we say in these webinars, we have those risk warnings and disclaimers at the start of the webinar to make you guys aware that we are not providing advice, just we're providing our opinion on the market, and we are very clear about that. It looks like the time has, we've run out of time. So for those of you who joined us live, thank you so much for doing so. Please don't forget to join us again for our regular sessions on Tuesday. And for those of you who are watching a recording of this, please ensure that you join us live next time, just so that you can ask us questions like some of the participants in this webinar did. Which may be more useful to you than watching this on YouTube. So good luck with the jobs report. I hope you guys have a successful day at trading and wish you a very happy weekend as well. Take care.
Good luck. Speak to you next week.